This just happened. The dollar index fell below a critical support level overnight, and most people have no idea what that means for silver. I'm talking about the 101 level, the same level that triggered the 2011 breakout, the same level the banks have defended for 3 years straight. It broke quietly while you were sleeping. And what happened next? Gold spiked, silver spiked. But here's what nobody's telling you. The paper market didn't follow. Physical did. That spread? That's the story. That's what I'm covering today. Before we go further, hit that subscribe button. You need to see what's coming next, and smash that like button if you're holding physical right now. Let me walk you through exactly what happened in the last 48 hours. The DXY, the dollar index, broke support at 101.3. That's the level it's been defending since October. 3 months of perfect defense. Every dip got bought, every breakdown got reversed. Until Friday afternoon, Eastern time, it cracked. And it didn't just crack, it fell hard. By Sunday night futures, we were at 100.6. That's a 70 basis point move in less than 72 hours. Now here's what makes this different. This wasn't a news event. There was no Fed speech, no jobs report, no crisis headline. This was positioning. This was someone, or multiple someones, getting out, fast. And when the dollar falls like that, gold should move, silver should move, and they did. Gold jumped $35, silver added 80 cents. But here's the part that matters. The COMEX premiums barely moved. The paper silver market, quiet, flat. Meanwhile, dealers in Europe, dealers in Asia, they started widening spreads immediately. Physical premiums went from $2.50 over spot to $3.80 in some markets overnight. That's not normal price discovery, that's a disconnect. That's what happens when the paper market doesn't have the metal to deliver. You see, when the dollar weakens, foreign buyers flood into gold and silver. It gets cheaper in their currency, so they buy. But if the COMEX isn't moving, where's the buying happening? Physical, bars, coins, vaults, and that's the pressure point. That's the thing they can't hide anymore. All right, let's talk about why this matters. Why this is different from every other dollar dip we've seen in the last 2 years. First, the setup. The dollar's been in a controlled descent since November. Managed, orderly. Every time it hit 101, buyers showed up. Central banks, sovereign funds, entities that don't want the dollar to collapse because they're holding trillions in dollar-denominated debt. But something changed last week, and I'll tell you what it was. China stopped rolling over Treasuries. Now, that didn't make headlines. You didn't see it on Bloomberg. But if you watch the overnight repo market, if you track foreign custody holdings at the Fed, it's there. The data's there. China's been slowly unwinding. Not dumping, unwinding. And last week, that unwind accelerated. We're talking about tens of billions in treasuries not being replaced. What does that do? It removes a dollar bid. And when the bid disappears, the dollar falls. But here's the key. Where does that money go? Gold, silver, commodities, real assets. China's not sitting in cash. They're rotating. And the rotation is happening through the physical market, not the paper market. So now you've got dollar weakness. You've got Chinese buying. And you've got a COMEX that's already on edge after 2 years of drawdowns. Let me explain what that means. The COMEX silver inventories hit a multi-year low in December. Registered silver, that's the silver available for delivery, dropped to 48 million ounces. That sounds like a lot. It's not. Annual industrial demand for silver is over 1 billion ounces. Solar alone takes 200 million. Investment demand, coins, bars, ETFs, another 300 million. So 48 million ounces, that's noise. That's 6 weeks of demand if things get tight. And things are getting tight. Dealers are reporting delays. Mints are reporting shortages. The U.S. Mint already suspended Silver Eagle production twice in the last 6 months. The Royal Canadian Mint, same story. Perth Mint, they stopped publishing inventory data altogether. Why? Because there's no metal, or there's not enough metal to meet demand at these prices. And now you've got the dollar breaking down, which means more foreign demand, which means more pressure on an already strained system. This is how 2011 started. This is how every silver breakout starts. The dollar weakens, demand spikes, inventories drain, and then boom, the price has to move. But here's the thing they don't want you to know. The banks are trapped. See, when silver was at 32s, 34, 38s, the banks could suppress. They could dump paper, they could hit the bid with unlimited contracts at 3 a.m. and kill the rally before it started. But now, after 2 years of industrial drawdowns, after China and India buying physical for 18 months straight, there's no more buffer. The inventories are gone, the physical market is tight, and if they dump paper now, if they try to suppress price while the dollar is collapsing, they'll just create more demand, more buying, more stress on delivery. They can't win. That's the point. They're in a corner. And the dollar breaking 101 just made that corner smaller. Let me show you the numbers. because this is where it gets undeniable. COMEX registered silver, 48 million ounces. That's the silver available for delivery. Not stored, not allocated, available. Open interest in silver futures, 120,000 contracts. Each contract is 5,000 ounces. That's 600 million ounces in paper claims. 600 million ounces in claims, 48 million ounces in metal. That's a 12-to-1 ratio, 12 paper ounces for every physical ounce. And that's just COMEX. That's not counting LBMA. That's not counting unallocated accounts. That's not counting ETFs that don't fully back their shares. If you add it all up, the real ratio is closer to 50-to-1, maybe higher. Now, in a normal market, that's fine, because most contracts settle in cash. Most traders don't want delivery. They're speculators, hedgers, market makers. But what happens when that changes? What happens when buyers start demanding physical? That's what happens. 2020, that's what happens. The price explodes because the system can't deliver. The paper market breaks. And suddenly, physical trades at a massive premium to spot. We're already seeing that. Europe, physical silver is trading $4 over spot in some markets. Asia, $5 over spot. Meanwhile, COMEX is barely budging. That's the crack. That's the fracture. And it's widening. Now let's talk demand. Global silver demand hit 1.2 billion ounces last year. Supply, 1 billion ounces. That's a 200 million ounce deficit. The biggest deficit in a decade. Where's that deficit coming from? Inventories, stockpiles, above ground supply. But here's the problem. Above ground supply isn't infinite, and it's not evenly distributed. Most of it, it's in China, it's in India, it's in the Middle East. Countries that are actively buying, not selling. The West is running out. The London vaults, down 30% in 2 years. COMEX, down 40%. ETFs, bleeding. SLV, the largest silver ETF, lost 15% of its holdings in the last year. So you've got declining supply, rising demand, a 200 million ounce deficit, and a dollar that just broke critical support. What do you think happens to price? Here's another number. Silver to gold ratio. Right now, historically, that ratio averages 60-to-1. In bull markets, it drops to 40-to-1. In 2011, it hit 32-to-1. If silver just reverts to the historical average, if it goes back to 60-to-1, that's a 45% move from here. We're talking $42 silver, minimum. And if it goes to 2011 levels, $90 silver. Easily, but it gets better. Industrial demand is accelerating. Solar installations are up 30% year over year. EV production up 25%. 5G infrastructure, medical devices, water purification, all of it needs silver. And those industries don't care about price. They need the metal. They'll pay whatever it takes. Meanwhile, investment demand is waking up. Oh, you're seeing it in coin sales. U.S. Mint sold 4.2 million Silver Eagles in Q4 alone. That's a 60% increase from the prior quarter. And that's before the mainstream catches on. That's before the breakout. That's before people realize the dollar's collapsing and they need to get into real assets. When that wave hits, when retail investors flood back into silver like they did in 2020, like they did in 2011, the system can't handle it. The mints can't produce enough. The dealers can't source enough. The COMEX can't deliver enough. And price has to go higher, a lot higher. So what happens next? Let me break this down for you because this is moving fast and you need to know what to watch. First, the next 72 hours. If the dollar stays below 101, you're going to see more physical buying. China's active right now. Middle Eastern buyers are active. They're not waiting. They're accumulating while premiums are still reasonable. Watch the dealer networks. Watch the premium spreads. If those spreads start widening beyond $4, if they hit 5, 6, 7 and over spot, that's your signal. That means the physical market is disconnecting from paper. And once that disconnect happens, it's self-reinforcing. Higher premiums attract more buyers. More buyers drain more inventory. Less inventory to higher premiums. It's a loop, and it doesn't stop until price adjusts. Second, this week, COMEX trading. Watch the open interest. Watch the registered inventory. If registered drops below 45 million ounces, that's critical. That's the level where delivery risk becomes real. And here's what I'm hearing from sources. Sources I can't name, but sources that are plugged in. They're expecting delivery notices to spike this month. February is traditionally a heavy delivery month. And if buyers are demanding physical, if they're standing for delivery instead of rolling contracts, that's going to put massive pressure on the banks. They'll have to source metal. They'll have to buy physical to cover. And when banks start buying physical to cover paper shorts, price moves fast. Third, before month end, central bank activity. This is the wild card. If the dollar keeps falling, you're going to see more central banks diversify out of dollars. They're not going to announce it. They're not going to hold a press conference. But the data will show up in custody accounts, in BIS reports, and gold import numbers. China's already doing it. Russia did it years ago. Now you're seeing smaller nations, Turkey, Kazakhstan, Poland, buying gold hand over fist. If that accelerates, if more central banks start rotating into gold and silver, that's endgame. That's the kind of demand the market can't absorb. We're talking about entities with hundreds of billions to deploy. And they don't care about $30 silver or $2,100 gold. They care about not holding devaluing dollars. So when does this break? When does the price actually move? My read? March. Maybe sooner. Here's why. The COMEX March contract is the next major delivery month. And if this dollar weakness continues, if foreign buyers keep demanding physical, if inventories keep draining, they won't have the metal to deliver. And when a major exchange can't deliver on contracts, when buyers realize the COMEX is a paper game with no metal backing, that's when confidence breaks. That's when the paper price becomes irrelevant. And that's when the real price, the physical price, takes over. You'll see it in premiums first. $10 over spot, $15 over spot. Then dealers start refusing to sell at spot. Then mints stop taking orders. Then the big boys, the institutional players, start hoarding. And once hoarding starts, it's over. The market locks up. And price? Price goes vertical. Now, I'm not saying this is guaranteed. Markets can stay irrational longer than you can stay solvent. But I am saying the setup is there. The pieces are in place. And the dollar breaking 101 was the trigger. Everything that happens from here is just follow through. All right, let's bring this home. Because I know a lot of you watching this are sitting on physical, or you're thinking about buying, or you're waiting for a dip. So let me be very clear about what this means for you. If you're holding physical right now, you're in the right position. Don't let short-term price swings shake you out. The paper market is going to stay volatile. They're going to hit it. They're going to try to scare you. But physical is physical. And when this breaks, your metal is going to be worth a lot more than spot. Hold tight. Watch the premiums. If premiums start spiking, that's your confirmation. That means the real market is moving, regardless of what COMEX says. If you're waiting to buy, stop waiting. I know everyone wants to time the bottom. I know you're hoping for $28 silver or $26 silver. But here's the reality, you might not get it. The market's changing. The dynamics are shifting. And if the dollar keeps falling, if physical demand keeps accelerating, you're going to look back at $30 silver and realize it was the floor, not the ceiling. Premiums are already rising. Availability is already tightening. And if this thing breaks in March, if we get a delivery squeeze, you won't be able to find metal at any price. Dealers will be sold out. Mints will have month-long delays. And you'll be stuck chasing price higher. Don't let that happen. If you've been on the fence, now's the time. Get your position before the window closes. If you're new to this, welcome. You picked a good time to pay attention. Because what's happening right now, this dollar breakdown, this physical shortage, this COMEX pressure, this is exactly what silver investors have been waiting for. Start small if you need to, but start. Get some physical in hand. Understand the difference between paper and metal. And most importantly, don't trust the price you see on screens. The real price is what you pay at a dealer. The real price is what someone's willing to sell to you today. And that price? It's going up. Now here's the thing nobody wants to talk about. Access. Right now, you can still buy silver. You can still call a dealer. You can still place an order, but that access isn't guaranteed. In 2020, when the pandemic hit, dealers ran out. Websites went down. Order queues stretched for weeks. Premiums doubled overnight. And if you didn't already have metal, you were out of luck. In 2011, same thing. Mints couldn't keep up. Dealers rationed inventory. Buyers paid massive premiums just to get product. And in both cases, the people who got in early, who bought before the rush, they did fine. The people who waited, they either paid through their nose or missed the move entirely. Don't be the second group. Don't assume you'll have time. Because once this accelerates, once the mainstream catches on, you won't. The smart money is already moving. The informed buyers are already stacking. And if you're watching this video, you're informed now too. So what are you waiting for? Look, I'm going to be straight with you. This is the moment. This is the setup we've been talking about for 2 years. Dollar weakness, physical tightness, inventory drawdowns, rising demand, a paper market that can't deliver. It's all here, right now. And once this window closes, once the breakout happens, once price starts moving, once premiums explode, there's no going back. There's no second chance. You either have metal or you don't. The dollar broke 101. That was the signal. Everything that happens from here is just confirmation. So watch closely, stay alert, check your dealer premiums every day, watch the COMEX inventories, watch the dollar index, and most importantly, be ready. Because this is moving fast, faster than 2020, faster than 2011. And when it breaks, it's going to catch a lot of people off guard. Don't be one of them. If you found this valuable, hit that like button. Subscribe if you haven't already. And drop a comment below. I want to know, are you buying? Are you holding? Are you waiting? Let me know where you're at. The next few weeks are critical. Stay sharp. Stay informed. And I'll see you in the next video. This is moving fast. Don't miss it.